Well, natural gas speculators are once again charging ahead with heroic confidence, lifting prices on Thursday as if the laws of supply and demand no longer apply, all while a bearish EIA storage report waves its arms in the background, begging for attention. The EIA logged a measly 12 billion cubic feet withdrawal for the week ending November 28, a far cry from the consensus call for an 18 billion cubic feet draw and miles lighter than the 5-year average pull of 43 billion cubic feet. In other words, commercial and residential demand simply didn't show up, even though parts of the northern U.S. were dealing with a respectable dose of cold during the period. And the real giveaway? Inventories are still sitting 191 billion cubic feet above the 5-year norm. Year over year, stockpiles are only 18 billion cubic feet shy of where they stood in 2024, hardly the kind of tightness that screams imminent shortage. The market was waiting for a decisive sign that early winter demand was kicking into gear, and instead got a polite shrug. Yet here we are, bulls merrily bidding prices higher, clinging to the hope that colder weather must be just around the corner. After all, why wait for actual data when you can trade on optimism? Meanwhile, European gas prices continue their freefall, serving as a not-so-subtle reminder to seasoned traders that U.S. gas futures are looking rather inflated at the moment. It's as if Europe is quietly tapping the market on the shoulder, saying, hey, just in case you forgot, fundamentals still matter. Meanwhile, near-term forecasts remain a mixed bag, offering just enough cold to keep traders alert but not nearly enough consistency to inspire confidence. Analysts expect national demand to stay elevated through the weekend as frigid air lingers over the northern U.S., supporting a respectable burst of heating needs. However, as we move into next week, that momentum softens, with demand easing back into the moderate to high range as milder air spreads across the east and south. Overall, the next few days should still deliver solid heating demand, but traders may be reluctant to chase the market higher unless the colder trends lock in again. If this early December cold snap fizzles out faster than hoped, the argument for a sustained rally becomes noticeably weaker. Natural gas futures are still walking a tightrope, supported by solid recent momentum yet facing technical signals that can't be ignored. Prices remain comfortably above the 200-day moving average, a key anchor for the current uptrend and the level keeping dip buyers engaged as weather volatility continues. Immediate resistance stands in the $5 to $5.10 region. A breakout above it could extend the rally toward $5.20, but repeated failures to clear $5 risk quick profit taking, especially if colder trends fade. On the downside, support sits at $4.90, with the more critical line at $4.70 near the 200-day MA. A close below that would signal fading bullish strength and expose deeper support around $4.45. Volume shows active but cautious participation, while momentum indicators like RSI remain stretched, warning that any weather disappointment could trigger a swift pullback. Bottom line, the setup still leans bullish above the 200-day average, but the bulls must keep control. Lose that support, and a sharper corrective move becomes likely. If you enjoyed the video, drop a comment, hit like and consider supporting the channel, it really helps keep things moving.